Hello viewers, I am again here with another video called Complete Guide to Risk Reward Ratio. Risk Reward Ratio are one of the most important in trading. That's what I am here today to let you know everything about risk reward. Don't be fooled by the risk reward ratio. It's not what you think. You can look for trade with a risk reward ratio of 1 is to 2 and remain a constant loser. I will prove it to you later. Similarly, you can look for trade with a risk reward ratio of less than 1 and remain constant profitable. Why? Because the risk reward ratio is only part of the equation. But don't worry. In this video, I will give you the complete picture so you will understand how to use the risk reward ratio the correct way. In this video, you will learn what is risk reward ratio, the secret to finding your edge, how to set a proper stop loss and define your risk, how to set a proper target and define your reward, how to analyze your risk reward ratio. Your risk reward ratio doesn't give you an edge. After this video, you will never see the risk reward ratio the same way again. Are you ready? So before begin, if you are new in the channel, I would really appreciate if you subscribe and follow the channel. And thanks a lot who already subscribed. Also please join me on Telegram channel where I published update regularly along with chart analyze. I need nothing from you except support. Your support can inspire me to make more video in the future. So let's begin. What is a risk reward ratio? The risk reward ratio measure how much your potential reward is for every dollar you risk. For example, if you have a risk reward ratio of 1 is to 3, it means you are risking $1 potentially to make $3. If you have a risk reward ratio of 1 is to 5, it means you are risking $1 to potentially make $5. Understand? Now I am going to tell you the secret biggest lie you have been told about the risk reward ratio. You need a minimum of 1 is to 2 reward ratio. That's wrong. Why? Because the risk reward ratio is measuring on its own. Don't believe me? Here is an example. Let's say you have a risk reward ratio of 1 is to 2. For every trade you win, you make $2. But your winning ratio is 25%. So out of 100 trades, you have 75% losing trade and 25 winners. So let's do the math. Total lost $75 in 75 trades. Total win $50 in 25 trades. So net profit negative $25. By now, I hope you understand the risk reward ratio by itself is a meaningless matrix. Instead, you must combine your risk reward ratio with your winning rate to know whether you will make money in the long run. Let me talk about secret to finding your edge. Here is an example. You made 100 trades. Out of 100, 60 were winning trades and 40 were losing trades. So here is the detail. This means your winning ratio is 60%. Here is the details. If your 60 winners brought you a profit of $150, then your average win is $2.5. If your 40 losers are $80, then your average loss is $2. So apply these figures to the expectancy formula. In this example, the expectancy of your trading strategy is 35%. This means your trading strategy will return 35 cents for every dollar trade over the long run. So here is the truth. There's no such things as a minimum of 1 is to 2 risk reward ratio because you can have 2 is to 1 risk reward ratio. If your winning rate is high enough, you will still be profitable in the long run. So, the most important metrics in your trading is not your risk reward ratio or winning rate, it's your expectancy. Now, let's talk about how to set a proper stop loss and define your risk. Now, you want to place a stop loss at an arbitrary level like 50, 100, or 150 pips. Do you think this is logical or wise decision? Instead, you can learn against the structure of the markets that act as a barrier that prevent the price from hitting your stops. Some of those market structure can be support and resistance, trend line, moving average. I made a lot of video about it. Please dig into the channel. You will find lot of important things that you are looking for. Next, you must have correct position sizing so you don't lose a huge capital when you get stop out. Here's the formula to do it. Position size equal to amount you're risking divided stop loss into value per pips. Let's say you risk $10 per trade. Your stop loss is 20 pips. Value per pips is $10. Now plug and play the numbers into the formula and you will get the size you need to play with. This means if your risk is $10 per trade and your stop loss is 20 pips, then you will need to play with 5 cents. Now let's talk about how to set proper target and define your reward. This is one of the most common question I get from traders. Well, there are a few ways to do it, but generally you need to set a target at the level where a good chance the market might reverse from, which means you expect opposition pressures to comes in. Here are three possible areas to set your target profit. Number 1, support and resistance. Number 2, Fibonacci extension. Number 3, chart pattern completion. Before moving forward, I would like to let you know that I made a complete course of educational video about candlestick psychology, which is 9 classes on our S class. So if you are interested, please let me know. You can find the details in the video description below. Okay, so support and resistance. Here's a quick definition of support and resistance. Support. Support is an area where potential buying pressure could comes in. Resistance. Resistance is an area where potential selling pressure could comes in. This means if you are in a long position, then you can consider taking profit at resistance. If you are in a short position, then you can consider taking profit at support. This technique is useful if the market is in range or a weak trend. Here is an example. But don't aim for the absolute highs, lows for your target because the market may not reach these levels before reverse. So be more conservative with your target profit and exit a few pips earlier. Number 2, Fibonacci extension. A Fibonacci extension lets you project the extension of the correct swing at the on 27, on 38 and on 61 extension. This technique is useful for a healthy or weak trend where the price trend to trend beyond the previous swing high before retracing lower in an uptrend. So, would not it be great if you can predict how high the market will go and exit your trade before the price retraces? That's when Fibonacci extension comes into play. Here's how to use it. Number 1, identify trending market. Number 2, draw the Fibonacci extension tools from the swing high to swing low. Number 3, set your target profit at on 27, on 38 or on 60 on extension. It's depend on how conservative or aggressive you are, and vice versa for an uptrend. Number 3, chart pattern completion. This is classical charting principles where the market trend to find exhaustion where a chart pattern completes. Now you are thinking how you will define completion of chart pattern. No problem. I am still here to tell you everything. Well, if the price moves an equal distance from the chart pattern, it is considered complete the chart pattern. Here is an example. Does it make sense? Well, because soon you will learn how to analyze your risk reward like a professional do. Let's move on. So you have learned how to set a proper stop loss and target profit. Now it's easy to calculate your potential risk reward ratio. Here are three simple steps to do it. Find out the distance of your stop loss. Find out the distance of your target profit. Distance of target profit to stop loss. Let's assume your stop loss is 100 pips and target profit is 200 pips. This means you have a potential risk reward ratio of 1 is to 2. Now remember on things. Your risk reward ratio is meaningless metrics by itself. You must combine your risk reward ratio with your winning ratio to qualify your edge. And the way to execute your trades consistently. You might be wondering, what if after 100 trades I am still losing money? Don't be disappointed. It's not an end of your trading career. In fact, you are probably ahead of 90% of traders out there as you clearly know what's not working. In fact, you are probably ahead of 90% of traders out there as you clearly know what is not working. If you're losing money with your trading strategy, here are four things you can do to fix it. Number one, trade with trend. Number two, set a proper stop loss. Number three, high OS technique. Number four, trade the justice levels. Let me talk about how to make it happen. Number one, how to trade with the trend and improve your winning rate. It's a no barrier that trading with the trend will increase the odds of your trade working out. So, here is a guideline for you. If the price is above the 200 period moving average, look for long setup. If the price is below than the 200 moving average, look for short setup and stay out if you have any doubt. Number 2, how to set a proper stop loss so you don't get stop out unnecessarily. Here is the things. Do not set a tight stop loss. It does not work that way. If your stop loss is too tight, then your trade does not have enough room to breathe and you will probably get stop out from the noise of the market even though your analysis is correct. So, how should you place your stop loss? Well, it should be at the level where it will invalidate your trading setup. This means if you are trading chart pattern, then your stop loss should be at the level where your chart pattern gets destroyed. If you are trading support and resistance, then your stop loss should be at the level where if the price reaches it, your support and resistance is broken. Let's move on. Number 3, the highway technique that improves your risk to reward. Here is the deal. When you enter a trade, you want to have little of struggle so the price can move smoothly from point A to point B. But the technique is, how do you find such trading opportunities? Let me introduce to you the highway technique because this is like driving on highway where you have little to no traffic in your way. Before you enter a long trade, make sure the market has room to move at least 1 is to 1 risk reward ratio. Why? Because you have a good chance of getting a 1:1 risk reward ratio on your trade, as there are no off struggle nearby. Now, if you want to further improve your risk to reward, then look for trading setup with a potential 1:2 or 1:3 risk reward ratio before the first swing high. However, this will reduce your trading opportunity too. Number 4, trade the justice levels. You are probably wondering, what do I mean by justice? Well, you want to trade support and resistance levels that are the most obvious to you. Why? Because these are the levels that attract the greatest amount of order flows, which can result in favorable risk to reward ratio on your trades. So let me show you how to find the justice levels. Number 1, zoom out the chart of your trading time frame. Number 2, mark out of the most obvious levels. Number 3, trade those levels only. As you can see, I have drawn some obvious levels in this chart. This is a levels. This is an intermediate levels. This is an intermediate levels too. And this is a support levels. So every time market hit these levels, we can see some price actions. From here we can see sellers entry, and from here also you can see sellers entry. From here you can see buyers entry, sellers entry, again broke, and sellers entry. So we can consider these four levels are obvious levels. I already made a video about it. You can find the details in the video description below. Few important tips. A level is more significant if there is a strong price actions. This means the price is spent only a short period of time at the level before moving away. So that's it from me today. Please make a thumbs up if you enjoy the video, and let me know in the comments box below what is next. Soon I will be again here with your expectation.